Welcome to the Deep Dive, the show designed to get you those key insights fast. Today we're jumping into the 2024 annual report from Farmer Mac. It's a really interesting organization, maybe one you haven't thought much about, but it seems to be a major force behind the scenes in rural America. Our mission: to cut through the usual report jargon and pull out what really matters, the stuff you need to understand their impact.
That's exactly it. We want to unpack this idea they talk about, liquidity in action. It's not just a slogan. We're looking at how it genuinely helps create opportunities, across rural America, specifically focusing on agriculture, obviously, but also crucial infrastructure. And this report, it's comprehensive, gives us a really detailed look at their operations and, well, the difference they're making.
Okay, let's unpack this right away then. Farmer Mac, the name makes you think in your tractors and fields, but it sounds like it's broader than that, doesn't it?
Yeah.
What exactly is Farmer Mac? What's their core purpose?
You're right to start there. The name is maybe a little simpler than the reality. Farmer Mac's basic mission is to make financing more accessible, both for American agriculture and for rural infrastructure. Think of them like a financial pipeline. They connect the big money markets, Wall Street and the like, with rural communities. These places often find it harder to get that kind of long-term funding. So liquidity in action really just means ensuring that capital flows reliably to these areas, like irrigation for the financial system.
Right, okay. So how does the secondary market thing work? It sounds a bit, abstract. Behind the scenes, can you make it clearer?
Yeah, it can sound abstract, but it's very practical. So Farmer Mac operates in the secondary market. What that means is they buy ag and rural infrastructure loans from the original lenders, the local banks in small towns.
Oh, okay.
By buying those loans, they give that local bank its money back faster.
So the bank isn't tied up.
Exactly. The bank gets capital freed up so it can then turn around and make more long-term, stable loans to other farmers or rural businesses. There's a great example in the report. Neil Kostelecki's family farm in Missouri, 360 acres. Farmer Mac bought his loan from HNB National Bank. And that action, that purchase, directly helped keep the farm in the family. It's about generational continuity.
So it's not just numbers on a page, it's preserving legacies.
Precisely. Preserving legacies, enabling growth. And what's interesting is how they manage risk and ensure stability. They do it through diversification. They have 5 main operating segments: farm and ranch, corporate ag finance, power and utilities, broadband infrastructure, and renewable energy.
Quite a spread.
Yeah, this broad base gives them real resilience. It's like having multiple strong pillars holding things up.
That diversification definitely sounds smart. So let's zoom in on that farm and ranch part first.
Yep.
Who are they actually reaching? I mean, when you think farming, sometimes you picture these huge corporate operations. Is that who's mostly benefiting here, or is it different?
That's a really important question, and the report is quite clear on this. They do work with larger operations, sure, but the data really emphasizes their focus on smaller, family-run farms. In 2024, in that core farm and ranch segment, small farms were, get this, 76% of the loans they purchased.
Wow, that's high.
It is. And family farms overall made up 96% of their ag portfolio.
96%.
Yeah. So this isn't just a footnote. It's directly helping with things like passing farms down through generations, supporting growth for these, often legacy businesses that are so vital to rural communities.
That's good to hear, especially since farming is, notoriously tough. What's the current situation, the outlook for things like farm income and land values? Are farmers facing more headwinds or tailwinds right now, or is it a bit of a mixed bag?
It's definitely complex. A mixed bag is a good way to put it. Farm profitability, well, it took a big hit in 2023. Net cash farm income dropped 25%. That was tough.
Ouch.
Yeah, but it did bounce back slightly, up 2% in 2024. And looking forward, the USDA is actually forecasting a pretty significant jump in 2025, up 22%.
22%. Why such a big increase?
A lot of that projected boost comes down to government support. There's a $33 billion increase in payments expected, mainly from the American Relief Act that was passed in 2024. It's designed to help buffer the sector. Now, on the land value side, the growth rate slowed down in late 2024. Higher interest rates, commodity prices kind of stagnating, those played a role.
Makes sense.
And it varies regionally. For instance, the 7th district, that's Iowa, Illinois, those areas saw basically no change. But the 10th district, Kansas, Missouri, Nebraska, saw a 5.5% increase.
Interesting variation.
It is. But even with growth slowing, the market seems pretty balanced, supply is still low, and demand is persistent.
So it sounds like there's some optimism, but definite pressures too.
Right.
What about other challenges? Beyond the financials, what else is impacting these communities? External stuff Farmer Mac has to deal with?
Oh, absolutely. There are significant external factors. One is the growing dependence of U.S. agriculture on foreign markets, and we're seeing shifts there. Exports are projected to drop to $170 billion in 2025. That's down 3% from 24, and actually 13% lower than the peak in 2022.
Why the drop?
Partly, it's the strong U.S. dollar making our stuff more expensive overseas, and just slower global economic growth overall. And then, there's the weather. It's becoming a huge factor.
Yeah, it seems like we hear about major disasters constantly.
The numbers are stark. In 2024, the U.S. had 27 separate billion-dollar weather disasters. That's just one shy of the record 28 in 2023.
27, that's incredible.
It is. And by the end of 2024, something like 70% of the U.S. was experiencing some level of drought or dryness. These events, they obviously hit agricultural productivity hard. They also impact the value of the land used as collateral,
Right.
which really underlines why Farmer Mac's stability is so important. They provide that steady, predictable capital. They act as a shock absorber, really. It lets communities invest in resilience, recovery, unlike, some private financing that might just dry up when things get tough or the weather turns bad.
Wow. Yeah, that really puts their role into perspective.
Yeah.
Okay, so beyond traditional farming, how else are they accelerating rural opportunities? You mentioned infrastructure. What does that look like? Things like internet, power.
Exactly. That's where their infrastructure finance business comes into play. It covers those other segments: power and utilities, broadband infrastructure, and renewable energy. And these investments are, well, they're critical for the long-term economic health and just basic connectivity of rural America. It's not just about farms anymore.
It's about making these places viable for everyone.
Right, making them places people can thrive in the 21st century. And if you look at the renewable energy segment, the growth there is pretty impressive. The portfolio more than tripled in 2024. Yeah, hit $1.4 billion in outstanding business volume. And it's actually doubled every single year since they started it back in 2020.
What's driving that?
Mostly declining costs for things like solar and wind, plus government incentives pushing renewables. And then there's broadband, telecommunications, data connectivity, increasingly vital everywhere, especially rural areas.
The digital divide is real.
Absolutely. So their broadband infrastructure segment, they actually separated it out as its own segment in late 2024, showing its importance. It saw a $0.3 billion net increase in business volume in 2024. That came from about $500 million in new loans and commitments. It's all about providing flexible financing to get high-speed internet out across rural America.
It's huge. What about power and utilities?
That segment actually saw a small net decrease, about $0.2 billion in 2024, but that was mainly due to some scheduled loan maturities, things just running their course. What's really notable there, though, is the stability. The report points out that this portfolio has never had a serious delinquency or default ever since it started.
Never. That's amazing for finance.
It really is. It reflects how stable that sector generally is. Power companies can usually pass on higher costs to customers, which insulates them a bit from economic swings, shows the low-risk profile.
Makes sense. Okay, so we've covered what they do and the areas they impact. But how does all this activity look on their books? What about Farmer Mac's own financial health and stability?
Right, connecting it back to their own performance. And 2024 was undeniably a very strong year for them financially. They finished the year with $1.5 billion in core capital. That's their financial cushion, basically.
And how does that compare to what's required?
It exceeds the minimum requirement by $584 million. So a very healthy buffer. Think of it like a family having almost double the emergency fund they legally need. It means they're incredibly resilient.
Okay, that's significant.
Yeah. They also hit a record for their net effective spread, or NES. That's a key measure of how profitable their lending is. It was $339.6 million, up $12.6 million from the year before. This strong performance led to core earnings of $171.6 million. And their Tier 1 capital ratio, another key measure of financial strength, was 14.2% at year-end. The minimum required is 7.0%.
So well above the minimum.
Way above. And this isn't just about having healthy finances for its own sake. This strength allows Farmer Mac to step in, sometimes as the lender of last resort for critical rural projects, especially when when maybe traditional banks might hesitate because of perceived risk or just the smaller scale. It highlights their unique kind of public-private role.
And how do they fund all this activity? Where does the money they lend out come from?
Good question. Their main revenue comes from interest on the loans they hold and fees they charge for guarantees and commitments. But they fund the purchase of those loans primarily by issuing their own debt in the public capital markets. So they borrow money to lend money, essentially. For example, at the end of 2024, they had $2.2 billion in short-term discount notes and $25.4 billion in medium-term notes outstanding.
So they tap into the big markets.
Exactly. That access is crucial. It lets them bring that liquidity in action we talked about right into rural areas, and usually at competitive rates.
And for listeners who might be interested from an investment angle, what about things like dividends for stockholders?
Yeah, the report addresses that too. For stockholders, it looks positive. They increased the quarterly dividend for the first quarter of 2025. It went up to $1.50 per common share. That's a 7% increase over the 2024 payout.
So signaling confidence.
Exactly. It aligns with their goal of providing competitive returns and shows they feel good about their ongoing performance. And, briefly on risk management, they seem quite sophisticated. They use tools like interest rate swaps to manage the risk of changing interest rates.
Like fixing the rate on their own borrowing?
Sort of, yeah. It helps make their funding costs more predictable, which is important when they're making long-term loans. They had about $19.1 billion in cleared swaps and $5.7 billion in non-cleared ones at year-end. And for credit risk, the risk of borrowers not paying back, while they do have significant exposure to a few large counterparties with their advantaged securities.
What does again?
They're investment-grade securities backed by pools of agricultural loans. And yes, $7.6 billion out of $8.5 billion outstanding were from just 3 counterparties. So concentration risk is there. But impressively, Farmer Mac states they haven't had any credit losses on any advantage securities ever over the entire life of the program.
Wow, okay. That speaks volumes about their risk management.
It really does. Robust assessment and management, even with those large exposures.
Okay, moving beyond the financials and the projects themselves, it seems clear there's a strong emphasis on the people, the team driving this. You mentioned these top workplaces awards. What makes them stand out, and why is that culture aspect so important for what they do?
It's absolutely critical. You need a dedicated, skilled team for this kind of mission-driven finance. They've earned a dozen regional and national top workplaces awards. And those are based on employee feedback through a national program, so it's not just internal spin. It suggests a genuinely positive culture.
How do they foster that?
Well, they have this hybrid model they call Presence with Purpose. It includes a specific collaboration Tuesday where people are encouraged to come into the office. It seems designed to get that in-person connection, teamwork, bumping into colleagues, solving problems together, not just flexibility for flexibility's sake.
Intentional connection.
Right. And to attract and keep the kind of talent they need, because rural finance has its own complexities, they offer a really strong benefits package. Things like up to 5 weeks vacation, 2 weeks sick leave, 11 paid holidays, 6 weeks of pregnancy and parental leave.
That's generous.
Very. And even 8 hours paid time for community service, which kind of connects them back to the communities they serve, plus an Equity for All program, employer-paid health premiums, good 401k contributions.
So they're investing in their people.
Heavily. They also have these various academies for professional development, new hire, skills, leadership, business, ethics, IT, cybersecurity. Apparently, all employees have started their leadership academy, which is quite a statement about developing internal talent.
Yeah, that is.
Plus, they're thinking ahead. Internship programs, a new associate program starting in 2025 for early career folks, a focus on succession planning. It really shows they see their workforce not just as an expense, but as, a core part of making the mission succeed long term.
This whole deep dive, it really paints a picture of Farmer Mac as, more than just a financial entity. It feels like a quiet but powerful force, really having a tangible impact across rural America. Sustaining family farms, helping build up crucial infrastructure like broadband and renewables, strengthening whole communities, really.
Exactly. When you piece it all together, the financial strategies, the way they channel liquidity, their focus on their people, it's clear how it all connects. It all contributes to creating real economic opportunity and hopefully long-term prosperity in these rural areas. They aren't just shuffling money around, they're trying to build resilience and foster genuine growth. And maybe that leads us to a final thought, something for you, the listener, to chew on. As technology keeps racing ahead and global markets keep shifting, how do you think that balance might change? The balance between, say, traditional farming and these newer demands for rural infrastructure like really advanced renewable energy or next-gen broadband. How will that balance evolve in the coming years? And maybe more critically, what kind of new financial tools or innovations might be needed to support those shifts, to make sure rural America doesn't just keep up but actually thrives?